Okay, good afternoon, good morning, and good afternoon, wherever you are right now and joining us from. Welcome to our webinar on the energy transition. And thank you for taking the time. I'm really excited for our webinar and looking forward with real experts in the field. The energy transition exactly we witness in the global energy market right now. We wanted to put this on the forefront of this in the light of the Russian war and the great impact on the sector that is almost comparable to the oil shock of the 1970s. And despite of these enormous uncertainties, the current juncture also offers a historic opportunity for this transition. And we want to manage to reconcile the security of supply with decarbonization and expand renewable energies and sector decoupling technologies. That can be really a path-breaking time for this topic, hence that is going to be our headline. But this paradigm shift is not only limited to the energy transition, we're also talking about other important themes that are related directly and indirectly, like, for example, mobility, food and water security, and climate change in general. So this provides us with a huge opportunity in investment portfolios, and we want to spend some time today to walk you through a couple of the insights that our esteemed friends from GlobalX have to hopefully provide you with some opportunities to boost the performance in your investment portfolios for the years to come. So we will explore in this webinar the landscape of the energy transition, and then, as I also mentioned, understanding other major themes within the landscape. And lastly, how to think about thematic investment in general, and if there's anything that is relevant for positioning in portfolios that is necessary. Then in the end, we will also leave some time for a Q&A session for all of you. So please use the Q&A button that you can see in the bottom and ask your questions. We'll try our best to answer all of them during the webinar. If there are any unanswered ones, we will get back to you after the webinar separately. Before we begin, it's also important, as usual, to draw your attention on our disclaimer. Please do note that none of the topics discussed today can or should be considered as investment advice or a recommendation. And these are for pure information and entertainment purposes only. Please contact your licensed advisor should you require any further information. And furthermore, please note that this session is also recorded. So if you wish not to have a recorded session, then yeah, that is also important to note. So yeah, with that done, let me move over a quick introduction for Kristal. I think most of you might know what Kristal is, who we are. We are reimagining and redefining private banking since 2016 by democratizing wealth management for all investors. We are providing best-in-class financial solutions across a broad spectrum of asset classes. Here you see our management committee. On the next slide, we are also showing you kind of like a highlight and suite of our products that we are offering for credit investors, access to equity, income, and hedge funds, mutual funds. Then we have a suite of venture capital, private equity funds on the platform. Also, startups and pre-IPO investment opportunities, and of course the conventional ones. For retail clients, we're also catering with our digitally focused investment offering. Okay. With that, I would like to go to introduce our esteemed panelists. So maybe I start with Pedro Palandrani. He's the Director of Research for GlobalX. Pedro joined GlobalX in 2019 as a research analyst covering the thematic growth suite of ETFs, including those in technology, people, and infrastructure categories. Prior to joining GlobalX, Pedro held the role of equity research analyst at Capital Wealth Management, where he worked in the growth-oriented investment strategy, utilizing ETFs to construct multi-asset portfolios. Pedro earned his MBA from Bertillon School of Business at Salem State University and a BA from Universidad Católica Andrés Bello de Venezuela. So, Pedro, muchas gracias and welcome to our webinar.
Thank you. Thanks for having me today, Tom.
Then we have Madeline Ruiz. She's a research analyst at GlobalX. Madeline joined GlobalX just recently in 2022, and she works as a research analyst covering ETFs within the thematic growth suite, particularly focusing on physical environment category. Prior to joining GlobalX, Madeline was a powers and renewable analyst with Fitch Solutions, where she led the research on markets within the Americas and global solar power industry trends. Madeline, thanks very much for joining us today.
Thanks for having me.
And last but not least, we have Alec Lucas as well, also a research analyst at GlobalX. Alex joined the firm in 2021, and he works as the analyst covering ETFs within the thematic growth suite, focusing on physical environment and people and demographic categories, also with regards to food and water. Prior to joining GlobalX, Alex was an intern as equity research analyst with Nikusa Investment Advisors, and he earned his Bachelor of Science in Finance and Value Investing from Fordham University in New York. Alec, thanks very much for coming.
Happy to be here.
And last but not least, most of you might know me already. I'm going to be your moderator and also probably providing one or few bits and pieces here and there. My name is Thomas Michael. I'm heading the trading and portfolio management at Kristal.AI. I'm leading the investment committee at Kristal as well. I have around 25 years of experience across various funds and investment banks as well. Prior to joining Kristal, I was working at JP Morgan in Singapore, where I have been responsible for management of the credit portfolio for the corporates and investment bank in the Asia Pacific region, which was spanning across the loan portfolio and the counterparty risk portfolio. So really excited to be your host for today. And yeah, I would say maybe we can dive straight into the subject here. As you might know, we like to start our webinars at Kristal with polls sometimes, and we've also our first poll that we want to start off with to see how well prepared or how interested our audience is today for the webinar. So I would like to ask okay, it started already. I would like to ask the audience what percentage of your portfolio is currently invested in commodities and energy-based thematics. So we'll leave this open for a couple of minutes and then we will share the results later with you. Thank you. So while we're giving here some time, I would like to start with Pedro, a question for you. Maybe we can start with a more broader dive at the subject here. So I would like to know from you, how do you think about thematic investing in general? And how would you go about selecting a particular theme to invest in?
Yeah, absolutely, Tom. I'm going to go ahead and share my screen if I can here. I think we're waiting for the poll to finalize here, I believe. But yeah, before sharing the screen, you know, here at GlobalX, when we think about thematic investing, it's really about the process of identifying disruptive macro level trends. You know, there are many of those around the world in terms of innovation, changes in consumer behaviors, changes in the physical infrastructure, many different emerging technologies that we're trying to capture. And of course, after identifying that disruptive disrupting macro level trend, we try to understand what are the best companies positioned to capitalize on those opportunities, right? So as you can think about it, it's a top-down, bottom-up approach that we're trying to implement here when it comes to thematic investing. And clearly for us, thematic investing serves as a great tool within investors' portfolios. So I think, let me try to share my screen here. I can after the poll. So very briefly, before we talk more about the themes that we wanted to discuss with you all today, briefly introduction about GlobalX. We're an ETF issuer based out of New York City. We manage over $40 billion in assets under management, more than 90 ETFs, everything from thematic investing, where we're going to be focusing on today, but also we have income-oriented ETFs, we have commodities, and a few other strategies. In terms of the AUM breakdown, about half of our assets are within our thematic suite of ETFs, and the rest of the assets are within these other suites that you're seeing on your screen. And this is kind of, again, visualizing the description of thematic investing that I was talking about before. In addition to that top-down, bottoms-up process, what it's important to understand is we're talking about long-term structural trends that are disrupting our economy. So those trends are really helping us to mitigate many of the short-term market dynamics that we see around the world. A well-constructed thematic ETF should also be unconstrained by geographic and sector definitions, tends to offer concentrated portfolios if you're including companies that generate over 50% of the revenue from the theme in regards, for example. And these are also relatable concepts. Clearly, for all of us as investors, it's easier to understand about electric vehicles and the importance of electric vehicles, or about solar and wind energy as they get cheaper and cheaper. And these are things that we can understand in very different to concepts like mean reversion or smart beta strategies. Thematic investing is really offering us an opportunity to invest in things that we believe in. And oftentimes here at GlobalX, we get asked a question about how do we choose an ETF, or how do we bring a market an ETF? And it really comes down to these three-step process. Number one, conviction. We want to have a high conviction in the theme. We'll look at total addressable market, revenue growth rates, path to profitability, until we gain that very high conviction in the theme. It should also be investable, meaning that we need at least 20 to 25 publicly traded companies before we bring an ETF to market. And finally, it should be long-term by definition, right? We're talking about trends that are going to play out over the next 5, 10, in some cases, evergreen trends. So that's a little bit of how we think about thematic investing. Of course, we have a lot to talk about today. Here's an S-shaped curve of adoption with many of the technologies that we're following around the world. But I'll stop there, Tom, to continue the conversation and see what are your questions around this topic today.
Yeah, so thanks very much for that introduction. I think that's great. I think one of the question I had is, like, when you identify the theme and you kind of like build a thesis around it and say, okay, this is now a disruptive theme, that's what we are going with. Like, how often do you review, is this theme still valid? Because obviously, I give one example is 5G, for example. 5 years ago, we were talking about 5G being disruptive and so forth. And now it seems to have come down a fair bit, and it's less important and it's less on the forefront of our minds. Do you change your view, or do you reassess, is it still disruptive or not, on a regular basis?
Yeah, we're constantly looking at the space and analyzing if these themes are still relevant. I think our belief is that as these themes mature enough, they're likely becoming more sector-like strategies. You can think about social media, probably one of the more mature themes around the world these days. And that's still one of our thematic ETFs. However, it's clearly becoming one of those more stable ETFs, as more, over 90% of the people with internet around the world uses any form of social media platforms. However, companies within the theme are now trying to diversify their revenue sources. Instead of focusing on growing their user base, they're focusing on growing the average revenue per user. They're trying to capture new verticals like the metaverse, for example. So yes, we're constantly looking at what are these themes trying to do. In the case of 5G, for example, for us, the investment strategy was, what are the companies that are going to benefit from the rollout of 5G technology? In our view, those companies were IoT companies, Internet of Things companies. If you think about it, the more rapid connection or internet that 5G is going to offer, a higher bandwidth, all of those benefits are just going to increase the adoption of connected devices around the world and many Internet of Things devices. So that was kind of the investment case for us in around 5G.
Got it. No, thanks very much for that. That's a good insight. Yeah, and anyway, I think I thank you very much for doing all this work, because I see this more from a advisory and portfolio allocator perspective. ETFs serve that are focusing on these thematic opportunities are serving a great purpose in our job as well, and for investors alike, because if you follow like a core and satellite approach by building a portfolio and constructing portfolios, it is very good to have the ability to focus on some of these disruptive themes in more detail. Okay, brilliant. Maybe we can quickly look into the results from the first poll. I don't know, Rohan, if you can share this for us and for the audience. Oh yeah, okay. So question was percentage invested in commodities and energy based to 0 to 5%, about 69%, and 6 to 20% in a larger category, 28%. Okay, that's pretty good, I think. Definitely interesting insights, and I hope that some of the takeaways from today's discussion change in one way or the other. So looking forward to know that. Maybe we go into some of the major themes in this landscape and dive a little bit into the topic. I mentioned in the beginning we were talking about energy transition and the importance of that. I think everything, in my opinion, everything is a little bit interconnected here. The impact of climate change that we have is, on the one side, you have the cause, on the other side, you have the consequence of it. So the usage of fossil fuels and the old way of our mobility and how we have been moving from place A to B has definitely brought us to the space where we are today. And then there's, of course, the results of that one, which is the food challenges to food security, impact of climate change on everything that we know as of so today. So maybe I want to focus a little bit more on this whole climate change topic. Madeline, if I may hand over to you, if you can tell us a little bit about how do you think about the topic of energy transition and climate change in the context of thematic investments?
Great, yeah. So let me share my screen. All right. So yeah, thank you, Thomas. So now on to climate change. And it's certainly important to note that the climate is changing at an accelerated pace and causing negative impacts for both humans and ecosystems. And recent reports from the Intergovernmental Panel on Climate Change, or IPCC, state that the causal relationship between human activities and temperature changes is unequivocally linked. Now, the good news is that many experts also contend that we have the tools and the agency and the technologies and strategies that can help us turn this around and minimize the losses and damages. So getting into the science, the chart on your left does a great job at visualizing how there's this causal relationship between human activities, particularly since the Industrial Revolution, and cumulative carbon dioxide or CO2 emissions. Atmospheric CO2 concentrations have increased 43% since the pre-industrial period, rising 100 times faster than ever recorded. And you can see how increasing carbon dioxide levels cause a blanketing effect in the atmosphere, which leads to higher temperatures. In terms of where we're at right now, we're at over 1.1 degrees Celsius of warming in comparison to the pre-industrial times. And this is really important to note, given that the consensus is that we need to limit warming to 1.5 to 2 degrees Celsius to avoid the worst impacts. So at 1.1 degrees Celsius, we are already seeing impacts with more frequent extreme weather events and the melting of glaciers and sea ice and resulting rising sea level. But looking forward, even a 2 degrees Celsius increase could have even more dramatic impacts. And this includes increasingly frequent and severe extreme heat events, droughts, and precipitation events. However, on our current path, warming could increase by as much as 3 degrees Celsius by 2100, which is well above those 1.5 to 2 degrees Celsius targets. So the takeaway here is that, we really need to try to do everything we can to avoid some of the worst climate change outcomes. And the positive news is that climate change mitigation efforts are accelerating across carbon-intensive sectors such as power, transport, industry, buildings, and agriculture. Focusing in on the power sector for now, the IEA estimates that electricity and heat generation correspond to around 40% of those global CO2 emissions. So investing in the tools and rapidly adopting renewables is really one way that we can reduce emissions and address climate change. And luckily, the transition to renewables is well underway. So the renewable sector's share of global electricity generation grew from 20% in 2011 to almost 30% in 2020. And you can see that strong growth in the chart on the top left. As seen in the chart on the top right, however, in order to limit warming to 1.5 degrees Celsius and reach net zero targets by 2050, renewables adoption will need to accelerate and reach an estimated 88% share by 2050. Looking forward, renewables, primarily wind and solar, are forecast to account for almost 95% of all power capacity additions through the medium term through 2026, this according to the IEA. And globally, renewables capacity is forecast to increase 60% between year-end 2020 and 2026 to reach 4,800 gigawatts. So for context, 4,800 gigawatts is roughly equivalent to global fossil fuel and nuclear power capacity combined. The strong growth outlook is really due to a variety of factors. So in the bottom left-hand corner, you can see that there's been significant private and public sector investment poured into the sector over the last decade, and we do expect that this will continue. Notably, there are increasingly supportive renewables policies in many countries worldwide, and not only do renewables present a way to mitigate climate change, but they also present countries with the potential for security.
Sorry, Madeline, I think we're losing your audio.
Oh, no. Can you hear me now?
Yeah.
Okay. So renewables present, a way to mitigate climate change, but they also present a way for countries to boost energy security, whether that's, to mitigate the effects of climate change or for political reasons as well. Corporate sustainability efforts will also continue to be a primary driver, particularly through power purchase agreements, which can help companies reduce their operational emissions. And finally, in addition, solar and wind energy are becoming increasingly cost competitive when compared to fossil fuel power sources, which you can see in the chart on your bottom right. So wind and solar have reached cost parity with fossil fuel power, and in some cases in countries, wind and solar are even cheaper. And I'll just end with this slide. We do have some diagrams here in terms of how solar and wind function on a very high level, which are worth checking out in the slide deck that will be provided to you. And on the corresponding graphs under each of them, however, we can see just how deep of cost reductions have occurred for solar PV cells, as well as wind power turbines. They've really benefited from economies of scale, increasing efficiency and innovations both in the technologies as well as the manufacturing, installation, and operation processes. So from an economic standpoint, the cost competitiveness for wind and solar is really important to justify investments into the sector and replacing those traditional oil, coal, and gas-fired power sources with renewables. So, certainly many positive trends over the last decade, and ones that we expect are set to continue over the long term. And yeah, I'll open it up to questions and discussion.
Yeah, thanks very much for that, Madeline. I had one question. You showed on the previous slide the investments, and given that we have seen already a sharp increase in investments from government spending in the sector as well, but putting it more into the current context, the moment we are dealing with this, especially in Europe, we are dealing with this situation of energy security that is impacted due to dependence on Russian oil and gas deliveries, gas even more so than just oil. Do you see this even more accelerating? And do you have any sense or anything that you have done by ways of analysis on by how much this could accelerate? Can this be the boost for that? Or do you think that the current need for energy security leads more to a shift back towards coal-fired power plants just to ensure that we have electricity, and which is going to be a little bit more dirtier for the next couple of years before the trend continues?
Yeah, no, that's a great question. So we do expect that the Russia-Ukraine war will actually accelerate renewables adoption, particularly in Europe. It's been a really good case for showing how countries can utilize renewable energy to boost energy independence. So in Europe's case, reducing dependence on those imports of fossil fuel feedstock from Russia. And so we haven't done analyses ourselves, but the EU has actually come out with a plan titled the Repower EU. And this is aimed at ending the region's reliance on Russia's fossil fuels, which will require a massive and accelerated scale up of renewable energy within the power sector, as well as electrification across industry, buildings, and transport. And in terms of what's going to happen with those natural gas and coal-fired power plants, they're also additionally over the near term, as they ramp up all of these cleaner energy sources that reduce reliance, looking to get their feedstock from other countries as well. But back to renewable energy, how could that impact it? So currently the EU's proposed Fit for 55 package, which sets a target towards 55% emissions reductions within the region by 2030, includes deploying hundreds of gigawatts of wind and solar power over the decade. And this would leave Europe with around 1,067 gigawatts of renewable energy capacity by 2030. The Repower EU plan looks to accelerate the speed of adoption of wind and solar and renewables, and this would yield 1,236 gigawatts by 2030. So almost an increase of 200 gigawatts, due specifically to the region's reaction to what's going on with Russia. And the plan also envisions the increasing use of energy efficiency measures, as well as the development, import, and use of green hydrogen. So yeah, we definitely think it will accelerate, green efforts throughout the region, particularly given that they do allow a way for the region to boost energy security.
Great, thanks for that. Okay, fantastic. Again, reminder for our audience, if you have any questions for the panelists, please use the Q&A button at the bottom of the screen, and we will get back to you. Something that's related to this topic of energy transition and renewables, and it gets me thinking when I think about power storage, because with all these intermittent energy sources or electricity sources, definitely a big theme that I'm focusing on in the strategies that I'm managing, Kristal, is the storage of power as well, as a battery technology and so forth. But Pedro, maybe that's a good segue into the mobility topic, or Madeline, if you want to add on something onto that one, that would be also interesting to see. How do you see the trends in that segment?
Yeah, so I can quickly touch on energy storage from the power sector. So, what really the only way that we can reach high levels of integration of renewables, as you say, is to significantly increase energy storage capacity. In the chart on your right, you can just see how, renewables are intermittent renewable or resources. You get peak generation when the sun is, shining the most and when it's windiest. And there is often this disconnect between when there's peak energy demand and when wind and solar energy peak. So this is, a prime opportunity to boost energy storage. In terms of the outlook for energy storage, so battery energy storage system costs, which is the primary form of energy storage, those costs have fallen significantly in the past few years, and we really do expect energy storage to take off over the coming decade. The US, China, Japan, Australia, the countries with the most renewables will be the ones that will really be leading the charge. And battery energy storage systems will definitely be the primary source. Those can usually store energy for 4 to 6 hours. But in addition, we will need long duration energy storage systems as well. So those use different technologies such as hydrogen-based storage, compressed air energy storage, and those will also have to ramp up significantly over the coming decades. Those can store energy for longer scale, 10 plus hours, days, even weeks. So it's definitely an important topic and an area that we feel that, increasing investments, increasing momentum and decreasing costs, increasing efficiencies of those technologies will allow it to really grow and support high levels of renewables integration. And I'll pass it along to Pedro if he has any other additional points.
Yeah, no, absolutely. That's a great point, Madeline. And I think what's important to understand is that some of the same technology that we're seeing being used by energy storage solutions clearly is a technology that we're seeing going into electric vehicles, right? So, Madeline, if you stop sharing your screen so I can share mine. So let me share my screen to share some information here with you. So if we think about from a high level about electric vehicles, I think in our view, it's clear that electrification of the transportation industry is unstoppable at this point. And it really comes down to these 4 different tailwinds that we're seeing in the market. Number one, innovation, where we're seeing a battery technology getting cheaper and cheaper. We're actually estimating that during the next 18 to 24 months, electric vehicles are already going to become cheaper than internal combustion engine cars in average. So that's really going to be an inflection point in terms of adoption of electric vehicles. At the same time, you're seeing pretty much every single car company around the world committing billions of dollars to electrify their car fleets, right? The regulatory environment continues to be very supportive. In China, there are some positive policies there, including subsidies, including free EV license plates. We're seeing the same in Europe with tax credits, in the United States as well. So all of those policies are really going to continue to boost EV demand. We wouldn't expect that to continue to be necessary just in 2 years. Like I said, once electric vehicles become cheaper than internal combustion engine cars, I think that's going to be clearly a no-brainer for consumers to buy an electric vehicle once that happens. And finally, consumer adoption. We're all more interested in buying electric vehicles. It offers a better driving experience. It's environmental friendly, and like I said before, it's getting cheaper and cheaper. So as consumers, we're also getting very interested in that. How can we, from an investment standpoint, invest in the supply chain within electric vehicles? Clearly, there's a very strong supply chain, everything from upstream mining activity. In our view, lithium is the key foundational raw material for battery technology that goes into electric vehicles and energy storage solutions like Madeline was talking about before. But then you also have areas of the market like chemical processing, cathode and anode production, cell manufacturing, until you get downstream to the actual electric vehicle manufacturer. So that's very important to understand. I guess that just to keep it short today, I'll focus on the upstream segment of that supply chain. Like I say, lithium as that key specialty chemical or commodity, however you want to call it, is definitely expected to increase in demand significantly over the next few years. Just for context, last year, lithium demand was about 480,000 metric tons of lithium. That's expected to grow to 2.5 million metric tons of lithium by 2030. That's a 5x growth for lithium demand. Unfortunately, we're entering into a lithium deficit this year, and this is driven clearly by the strong demand for lithium from areas like electric vehicles, for example, but at the same time, by the inelastic nature of supply. And this essentially means that bringing lithium to market is not as easy as it sounds, or as easy as we need it to be to keep up with the demand. In average, it takes 3 to 5 years to actually bring lithium to market. So it takes a lot of time, and that's really one of the key constraints of bringing lithium to market. And in our view, the reason why lithium is likely going to be on a structural deficit, at least over the next 2 to 3 years. If you think about that, that's driving up prices of lithium, which are 10x from their historical average. And at the same time, this is benefiting lithium miners. Lithium miners are reporting very strong top-line revenue growth, margin expansion as a result of the high lithium prices. And in our view, lithium miners are definitely very well positioned under this market environment, in a market environment where commodities also tend to benefit from inflationary pressures, right? So I guess that lithium is definitely one of those top ideas for us.
Great. No, that's interesting. We actually did have a question about the lithium supply imbalances. I guess that is answered by that. Also, the same for lithium. I think we witnessed this across most mining, metals mining, etc. There has been a consistent underinvestment in that space for the last decades, pretty much, and it seems now that this is coming to the forefront, and is therefore putting this inflationary pressure on prices here. Yeah. Oh, that's great. Thanks, Pedro. With that, I mean, moving a little bit from the mobility and energy storage, another sector that has been greatly impacted by rising energy costs has been the food space, and I think food and water is, for me, also one of those thematic parts that is close to my heart. It's about how do we feed a growing world population in a more sustainable way. Also, how do we provide access to clean water? So this is really like the basic necessities that are very important and that have been a little bit underappreciated in the last decades. So maybe I can hand it over, Alec, to you. If you can quickly share your thoughts on this sector and what themes do you see here?
Sure. Is my screen sharing correctly here?
Yes.
Perfect. So I think at first the link between agriculture and the energy transition might not be apparent. We're thinking of traditional agriculture as something that's in a different sphere, but when you look closer, they're very closely linked. Agricultural systems are responsible for about 18% of emissions. So certainly it's not just this cause-effect relationship. Climate change causes food insecurity, or climate change causes water scarcity. There's this feedback loop where the effects of climate change might lead to food scarcity, which might lead to these unsustainable, very intensive agricultural processes, which feed back into climate change. So that's sort of the framework we're working with here, and it's why more sustainable agriculture is so important for feeding our populations moving forward, not just logistically getting food on the table, but also addressing these climate change issues. And we're expected to have to increase food production by about 50% between 2020 and 2050. So certainly we have to search for these innovative solutions to be able to feed our populations without contributing to these greenhouse gases, which, as Madeline mentioned, we have to desperately curtail. And there's a few technologies that we're looking at as being able to do this. And one of them is precision agriculture, which is a pretty broad bucket, but it's any technique or technology that seeks to maximize crop yields while conserving your traditional inputs, such as water, fertilizer, pesticide, etc. And there's a lot of different technologies that can assist us with Internet of Things sensors, artificial intelligence, certainly agricultural robots, these autonomous equipment, we're seeing being very helpful here. And this diagram here on the right hand has a lot of helpful statistics in terms of how adoption of precision agriculture has helped with resource savings. You see that bottom left, in some cases, precision agriculture has reduced herbicide use by close to 80%. Certainly, it's a technology that's known to conserve water, conserve fossil fuel use, which is also very important as we consider climate change. I do want to draw attention to that top right-hand statistic near the satellite, the 32% reduction in nitrogen use through variable rate applications. Nitrogen use in this case refers to nitrogen-based fertilizer, which, along with potassium and phosphorus, are the three most important fertilizers that we use. Certainly this variable rate application, great example of precision agriculture at work. In this framework, you're implementing an array of sensors that go into the ground with crops, and you're transmitting information about the crop health. That's nutrient level, moisture as well. And you're cross-referencing that information with satellite imaging to create these very specific and advanced instructions for farmers or autonomous vehicles. So what that might look like is one crop needs a certain amount of fertilizer, but let's say another crop is performing better and doesn't necessarily require as many resources there. So by knowing that information, farmers can avoid needlessly wasting resources. This is important in general as we're trying to conserve resources and trying to be more environmentally efficient, but also in the context of high input prices, what's going on with Russia-Ukraine situation in terms of fertilizer and as well as commodity pricing. This can be extremely valuable moving forward in terms of reducing our carbon footprint for agriculture as well as just our resource intensity. Another technology we focus on is controlled environmental agriculture, which similarly, you see resource savings here. This is when you're cultivating crops in any sort of non-traditional enclosed environment. This can be a greenhouse, which we're more familiar with, or this can be something like a vertical farm where you have these stacks of crops and a flow of nutrients, which you can unlock synergies that way. And the main benefit here is geographically. You're saving space. These are, you can see that bottom left-hand chart. With a vertical farm, you can use a fraction of the land to produce the same amount of output. So this is very helpful. You're also, because you have a high degree of control over these environments, you're using less inputs. Again, the herbicide, the fertilizer, water. In the case of vertical farms, you're using 95% less water in some cases. Also important for climate change as well, because these are enclosed environments, they're more protected against the elements. Variance in weather from seasonal variations, and also these effects of climate change, which Madeline was describing earlier as well. And also the last benefit here too is because these are more land efficient facilities, you're able to place them in close proximity to population centers, the end user. So you end up not only having less waste in your supply chains, but because you're closer, you're actually using less fossil fuel to transport these goods as well. So in a lot of different ways, these precision agriculture techniques, these controlled environments can be very helpful, not only in terms of boosting our output, but also addressing this climate issue with agriculture.
Alec, we actually have got a question that came up exactly to that topic. And I do think about it as well a lot, is the difference between developed market versus emerging markets. Do you think that precision agriculture has enough applicability across emerging markets as well?
Well, so it's a great question. I think the short answer is it's not a one-size-fits-all sort of approach. So certainly you're seeing in markets, let's say China, where you're seeing the average age of farmers exceed high 60s. So that's a market where you might see precision agriculture, which also pairs well with autonomous agricultural robots, which can help sort of solve labor shortages. That might be a market where you could see precision agriculture play more of a benefit. Perhaps a market like Africa, where certainly you're looking to save inputs, but perhaps a controlled environment or even agricultural biotech, which is a technique which you can use to perhaps a trend that we're seeing is trying to splice these genes in order to enhance nitrogen fixation of crops. That might be a better technique, more suited to the environment there. Again, it's not necessarily a one-size-fits-all, but we think that between these controlled environments, between precision agriculture, between agricultural biotech, these are techniques that have a lot of usefulness throughout different markets.
Perfect, thanks. Yeah, we have a lot of that. That was great, Alec. Thanks very much for that. That's very interesting. Maybe I have one more question on that topic, is with regards to investability, because especially food and agricultural space, I also did some exploration into the sector in my career, and I see most of the opportunities here, or most of these revolutionary technologies, they're still more in the private space. Often what happens then is that startups, once they're established, they get bought up by larger conglomerates or corporates. In your research, when you are looking at the components of your ETFs, are you doing the look through of large corporations? Like, what is their, let's say, their VC exposure, private equity exposure that they might have to that? Or how do you find these opportunities?
So Pedro might be able to cover the private equity aspect of that, but in terms of the pure play exposure to agriculture, this is a theme that we consider earlier in its adoption, and there's certain characteristics that we look at. The goal is always to promote as much pure play exposure as possible, and certainly in this space there are some prominent players. AppHarvest is a controlled environment player, which it's focused on lettuce and tomatoes. You also have Hydrofarm Holdings, which is more of those controlled environment agriculture, more of the environmental, the lighting, the water pumps that you use in those spaces. So those are examples of pure plays that we can include. Certainly in the alternative food space, you see Oatly, you see Beyond Meat. But the idea here too is when you focus on the pure plays, but when you're in an early adoption theme, it's also important to focus on these players that have diversified revenues, that have pre-revenue, that they don't necessarily meet the requirements for a pure play right now, but they certainly could be prominent players in the space moving forward. An example, Deere & Company is certainly a prominent player in a lot of spaces, in the infrastructure space, in the agriculture space. But it's going to be one of the more prominent providers of autonomous tractors. So even though that's not necessarily a pure play on the ag tech space, it's important to capture that early to get that exposure. Pedro, if you want to touch on anything there, go ahead.
Yeah, I was going to say, like, Tom, clearly we look at the universe of companies around the world to try to determine what are the companies that are best exposed to capture the theme. And like Alec mentioned, the goal is always try to provide the more pure play exposure, meaning that in most cases, our ETFs require companies to generate at least 50% of the revenue from the theme in regards. However, there are exceptions, like Alec mentioned, where in order to capture the early nature of a given theme, we require some companies to either have diversified revenue sources, or we look at the R&D spending. We look at, by using a natural language processing algorithm, you can try to identify which company is trying to grow in a given vertical or theme. So that's kind of the goal. But to your point, yes, we're constantly looking at what these companies are doing around the world for these given themes. We're also keeping track of the private market to see what's the potential IPO pipeline that might increase the pure play nature of a given theme. So clearly, these are all of the things that we're looking at when launching an ETF and when managing the ETF after the launch.
Perfect. Yeah. Okay. Cool. I want to move it to the last topic, because we also said that we want to give a little bit of guidelines or guidance as to how do investors position in this environment as well, and certain takeaways. We have one question that actually fits straight away into this one, and I wanted to open it up to the panel. There was a question about what do you suggest, where can an investor invest in these energy thematic opportunities, and if there's a specific fund or basket for the longer term horizon. Do you have any particular views on that, or?
Yeah, well, I would say, clearly here at GlobalX, we have 36 different thematic ETFs, many of which sit within the climate change suite that we consider, and that includes renewable energy producers, that includes clean tech companies, those companies developing the technology and manufacturing these technology that are used by renewable energy producers. We have solar ETF, we have a wind ETF, we have a hydrogen ETF. I was seeing on the Q&A a question about fuel cell technology versus lithium technology. And we'll also talk a little bit about lithium and battery technology. We have the world's largest lithium and battery technology ETF as well that can provide this type of exposure.
Yeah, and just generally, I mean, do investors need to have a different approach when looking at thematics? Do you adjust your? Would you recommend that we look at a different time horizon that investors should have in mind? And are ETFs the best way to get exposure to such themes?
I'll start with the latter. Clearly, when you're looking at emerging themes, emerging technologies, it's very hard to identify who's going to be the winner and who's going to be the loser. So in order to minimize risk and increase your diversification, an ETF can really provide exposure to the universe of companies in a given theme. In our view, that's the best way to potentially capture that theme. If you have that long-term view, that's something that's going to play out over the next 5 to 10 years, then kind of just investing in the universe of companies is definitely going to help investors. In our ETF, the best way that we're trying to capture those winners is by having a market cap weighting scheme within the fund, right? So that essentially, Tom, lets you have more of the winners as having higher weight within the portfolio, and the losers having a lower weight within the portfolio. So that's a better approach than an equal weight strategy, where at each rebalance and reconstitution ends up buying more of the losers and selling some of the winners, right? So yeah, that's a couple of the different ways that we try to address to provide the best exposure here for a given theme.
Yeah, exactly. And I can also subscribe to that and confirm that as well, because as I said, I manage some strategies for Kristal. One of them is an equity strategy focusing on exactly those themes that we are talking about. And I spend a good time of my day reading through filings, going through competitive analysis, like what is the competitive landscape for different companies. So if you do this as an individual investor or private investor with a day job as well, that takes up a considerable amount of time, and especially earnings season is always a busy season for me. So yeah, there's definitely a certain convenience to go into an actively managed product or an ETF there. Yeah.
Absolutely.
And when you look at thematic investments, would you suggest that you have different expectations towards volatility and drawdown of these investments? Like, how patient do our clients have to be when they go for thematics?
I think, thematic investing should be part of the strategic asset allocation within a portfolio, not so much that tactical allocation. Sometimes, clearly, investors are trying to capture the hype of a theme when everyone's talking about a given theme. But in our view, that's the wrong way of doing it. For us, it's kind of, again, that long-term strategic exposure within a portfolio that over the long term, it should definitely play out. So in our view, it's less about the timing of a strategy, but more about the time, right? Trying to invest in things that are going to play out over the future, or that we believe are going to play out over the next few years. That makes sense, Tom.
Yeah. No, because the reason why I asked that question was we did have actually one question about thematics being more tactical or a core role in a long-term strategic allocation. I mean, to what you said, Pedro, I would just add on to that. I think it is important to keep in mind that there is often more volatility involved, and investors might suffer bigger drawdowns. So if this becomes the core allocation, then yes, it depends always on the investment horizon, but need to be prepared that these thematic investments, they often have a higher volatility than if you go broad index.
Yeah, and these are by nature growth-oriented strategies, and you're right, they tend to have more volatility. As a result, usually we see our clients, most of them here in the United States, using thematic ETFs as a satellite approach to the core equity allocation within a portfolio. So say that you're overweighting or underweighting your benchmark to, I don't know, financial services, for example. You're trying to capture alpha or diversify your exposure to financial services. Our clients might use that a fintech ETF as that satellite approach in a way to try to capture the growth opportunities within financial services sector. So it's not a larger portion of the portfolio, but our clients in average might use thematic ETFs as a 5 to 10% allocation within a portfolio.
Sorry, I was on mute. Yeah, I also see in the queue, we received a number of questions asking for particular advice on which product, which ETF. Please, for all, keep in mind or bear in mind that we are not able to give you any product-specific advice in this webinar. If you have any questions, if you're looking for something in particular, we do have, you can reach out to your advisor at Kristal and to your RM, or you send us an email to support at Kristal.AI, and we will be able to help you answering your relevant questions when they are product specific. That is because we need to know your risk profile and so forth. So we won't be able to answer those on the webinar itself. But I had another interesting question here from the audience, is with regards to the renewable energy, whether there's enough supporting infrastructure across the globe, such as in, for example, the mobility space. Maybe Madeline, if you can help us with that.
Yeah, I can briefly just touch. So within the mobility space for electric vehicles, the battery electric vehicle charging network is much more developed than the hydrogen fuel cell and the hydrogen fueling stations. Therefore, in our view, we expect that battery electric vehicles will be the car type of choice for passengers in terms of EVs, and hydrogen fuel cell EVs could be used for industry and long haul transport, in more specific cases. But we expect that those networks, will continue to expand. Within the power sector, transmission and distribution infrastructure is often a key hindrance for widespread renewables growth. Even in the U.S., we have a very disconnected grid and very few inter-regional connections. So that's an area where, without that transmission and distribution infrastructure, if something's blocking, like permitting or policy, energy storage is one way that can really help the grid in the near to medium term, delay the needs for transmission upgrades, or getting rid of that need for a specific project.
Great, thank you. Okay, I have one question as well for the panel, whoever wants to volunteer on this one. But we were talking earlier about most of these companies in the disruptive sectors and then thematic investments are growth companies. Now, we do live, thanks to the rise in energy and food prices, we do live in a highly inflationary environment right now. Interest rates are going up and set to go up even further, possibly. How do you see this impacting the trajectory of, for example, with regards to energy transition? Melanie, you were also sharing a slide about the cost of solar cells. And I know a solar project, it requires a lot of upfront capital. The financing for that has often been debt financed. Do you see any, is this like one of the risk factors that you have in mind when you're looking at these energy transition themes?
Yeah, definitely. Oh, I'll let Pedro answer if he wants.
No, go for it, Madeline.
So yeah, over the near term, we are seeing increasing costs in wind and solar power projects. You know, throughout the solar value chain, not only has there been inflationary pressure, but there's also been increasing levels of supply chain disruptions due to the start of the COVID-19 pandemic. So over the last couple of years, for example, within the solar industry, we have seen a shortage of polysilicon, not only due to disruptions in production, but just also increasing demand and the level of polysilicon production is not being able to keep up. These are things that we expect could be more of a short-term trend. So over the long term, we do expect that, you know, production for polysilicon will begin to ramp up and, you know, start to meet the demand. In addition, additional efficiency gains in installation, operations, and continued improvements in solar modules and wind turbines will allow costs to continue to come down over the long term. But it is something that we're seeing in the near term throughout markets across the globe.
Mm. Okay. No, perfect. So in other words, if I understood this correctly, your it's basically outpacing the efficiencies, outpacing the draw effects. Okay, interesting. Good. Okay, I think we're well within time. Do we have any other questions that we want to take there? Oh, there was one interesting one. Maybe, Pedro, I can pass this to you because it's very technical. Do you see silicon carbide as a substitute for lithium batteries going forward?
Yeah, I think silicon carbide is currently being used mostly in semiconductors for electric vehicles, for chips. Actually, Tesla, I think, uses that within one of their inverters. I think for what I've read, it has the potential to be used within electric vehicles and more so within the batteries. You know, battery companies are technically trying to, number one, increase the energy density to increase the range, the capacity of these batteries. Number two, do that in a way that it has a lower cost than the previous generation of battery technology, and all of that while trying to keep up with the safety of the battery, right? So I think newer technologies are going to try to solve for that puzzle. What I can tell you is that lithium-ion battery is being the technology of choice over the last 20 years for these battery companies. Of course, it's just been like 5 to 6 years where a mainstream adoption of electric vehicles became a reality, and lithium-ion technology was the option of choice within the industry, right? So in our view, lithium-ion batteries are definitely going to be the gold standard for the next 10 to 15 years. I think there is no doubt around that. In terms of cost, it's kind of the cheaper version. What you're seeing within that technology is different uses of chemistries, right? So you have nickel-based batteries, you have iron-based batteries. Within those, you have different chemistry options. But again, the ultimate goal is to increase energy density to lower the cost, just in a way to try to increase adoption of electric vehicles. Long way to answer that silicon carbide might be a part of one of the technologies, not a replacement for lithium-ion batteries, but maybe part of the overall energy mix within battery tech.
Got it. But do you see, I mean, I just like to add on to that one. I mean, this is probably for those old enough on this in this webinar who know this still, but is it like in the 80s, the videotapes, you had VHS, you had Betamax, and there was only one survivor. Do you think that there is enough space in this industry to have multiple solutions, or will there be only one survivor?
I think that there's probably going to be a few solutions overlapping over the long term. But again, I think all of them surround the use of lithium-ion battery technology. Even if you talk about solid-state battery, that's a different version of lithium-ion batteries, right? It just means that your separator within the battery, again, cathode separator, anode, that separator is expected to be solid instead of liquid. And again, that's just one of the different variations of battery technology that it's trying to solve for the puzzle that I had before. But in my view, you know, lithium-ion batteries are definitely here to stay, at least over the next 10 to 15 years.
Understood. There's one last question that came in. I would like to take that if I may. So the question was, is nuclear power being overlooked as a relatively greener source? I would just say to that the answer to that is, in broad terms, yes. I think there is a political resistance that you have. I mean, Germany announced their exit out of nuclear energy a couple of years ago. Japan, after Fukushima, same way that they have actually held back on that one. I personally think that nuclear power is one of the cleanest energy sources that we have. It is just psychologically not very well accepted, and there's a fair amount of political resistance to that. However, we do see a fair amount of investment in that space. If you look at the investment that China has made in nuclear power plants, there's about 14 nuclear reactors coming online in the next couple of years. There's a massive amount of capacity that is built up in that space. UK also recently announced that it's increasing nuclear power capacity by 25%. However, the problem with that sector is that it's very sensitive to interest rates as well, given the high upfront investment. It takes multiple years of building a power plant. So it's not something that can be as quickly done as, for example, solar panel installation or wind turbines. So I don't think it's overlooked. It is just that in certain geographies, the political acceptance to accept nuclear power is relatively lower. Therefore, I think it's not going to play that much of a substantial role in the mix. But there's a couple of interesting themes as well, because uranium has a similar underinvestment story as what we have with lithium, for example. And there's a couple of interesting investment themes in that space as well. Okay, I think we are just a little bit over time. I would like to wrap it up because a couple of our attendants have also moved on. So thanks very much, Madeline, Pedro, and Alec for joining us for this webinar today. It was really very interesting. We will be sharing the slides of the presentation on our platform later on. And I would like to thank for your time, sharing your insights on very different segments. I would like to thank our audience as well for participating with a very lively Q&A session. And it has been a real pleasure being your host for the day. Thank you very much.
Thanks for having us, Tom.